Hi, today we are going to talk about the cash flow from financing activities. Exciting, right? Yes. So, the cash flow from financing activities involve the company debt and equity. Okay? In my last video, I told you I wouldn't include any securities in the cash flow from investing activities in order to keep everything clean and clear in your mind. Okay, so here is the reason why. I repeat, the cash flow from financing activities of a company is related to the firm's debt and its equity. Okay, which is in direct relationship, of course, with securities. Now, let us see this in more details. Okay, so the, the structure of the cash flow from financing activities is as follows. We have the proceeds from long-term debt sales, okay? The proceeds from new stocks issue, the dividends, okay, and the purchase of stocks. All these are equal to the total cash flow from financing activities. Okay, note that this is a very simplified format. Now, how to differentiate the debt from the equity? Good question. This week, though, we are going to proceed with the equity, and next time we will see the debt. First thing first, remember that the rule of the financing activities is debt minus equity equal to financing income. Weird, right? Think about it. A debt is something that you have to repay, right? So it should be the one weighing your finances down, right? My sweetie, we are in the statement of cash flow here, okay? Just like in your life, believe in the impossible, calm your worries down and keep washing. Sweet. So, first, equity. The term equity is related to stockholders or shareholders. Know that when a legal company starts issuing stocks publicly in the stock market and the firm is managed by many professional executives, this form of business is called a corporation. Okay. Also, the stock market facilitates equity investment into firms and the transfer of equity investment between investors. Okay, so the term equity implies, first of all, paying out dividends. Okay, for example, there are two different kinds of life insurance companies. We have the stocks and we have the mutuals. Okay, the stock companies pay out earnings to stockholders first and potentially to policyholders. Mutual companies, on the other hand, have no shareholders and only pay out earnings to their policyholders. Okay, now the policyholders' profit are what we refer to as dividends. Second, equity implies the repurchase of stocks or shares. That means that even after a firm has gone public, it can repurchase some of the shares that it previously issued. Okay? Usually, firm managers do it so when they believe that the company's stock are undervalued. Okay, undervalued means the stocks are at lower prices based on the valuation of what the shares are really worth. I hope that it makes sense. Okay, finally, equity implies the issuance of new shares. Okay, the issuance of new shares is also referred to as secondary stocks offering. When a firm's stocks are already trading publicly in the stock market and the firm decides to offer more of these shares to the public, this practice is called secondary stocks offering. Okay, we will see this in more detail in another video, so don't worry. So, wrapping up all I have said today, you see that in the above structure of the cash flow from financing activities, equity represents the dividends and the repurchase of stocks. Why does equity have a minus sign in front of the terms? Okay, because the term will use some cash to pay out dividends and to repurchase some of its stocks, of course. Okay, now this is the end of this video. I hope that you have understood something. I'll see you next time. You all take care.